One of the hardest things to do as an investor is to sell a stock that you own, especially one that you are really excited about. Today, I'm going to tell you why I'm going to be selling shares of Riskified, a stock that I was very excited about, but now I'm ready to part ways. And hopefully, by hearing my reasoning, it might make sell decisions easier for you. My name is Brian Stoffel. So if you look at this stock chart, you can see that my investment in Riskified has not been a good one. I bought at the all-time high, and when I sell my shares, it's going to be all the way down here. That is literally buying high and selling low, usually what we want to avoid when we're making an investment. But I'm still willing to do it. To understand why I'm willing to sell shares, even though the stock is down by so much, it's important to revisit our thesis. Now, Riskified is a company many people might not know about, so let's review this real quick. The company's mission is to empower business by realizing the full potential of e-commerce by making it safe, accessible, and frictionless. What does that mean? Well, Riskified is in the business of reducing chargebacks for e-commerce players. Amazon being the largest e-commerce players, but there are many others like Wayfair and Etsy. So here's what happens when a chargeback is made. Typically, a buyer makes a decision to buy a product and it's shipped to them. However, once it's shipped to them, something happens. Either it's the wrong item or it's damaged. Maybe it's a charge that the buyer didn't actually make, or maybe that buyer is perpetrating some type of fraud or theft. Once the buyer notifies their credit card company, then there's a chargeback where the buyer gets their money back and the e-commerce company is left without the money and the inventory that they sent in the first place. Now, if you run your own e-commerce site and you want to avoid these types of chargebacks, then you need to create a system to identify when it might be possible and then deny those purchases when they're made. As you can see from this figure here, that can be a mind-bending headache to try and figure out. Riskified basically says that instead of that huge maze of confusion, you can simply plug in this software and it can approve purchases for you by measuring the risk of any specific buyer. Now, here's where the proof is really in the pudding. If I run an e-commerce website and I want to know if Riskified works, here's what it's telling me. If I sign a contract with Riskified and Riskified is in charge of approving or denying specific purchases, it's a no-lose situation. Here's why. On the left, you can see that of Riskified's 10 largest customers, they are able to cut down on spending to prevent fraud by 39%. That's huge savings. But it doesn't stop there, because if you're using Riskified software, then you're able to approve more purchases, and that leads to an 8% bump in revenue. Now, already that seems like a no-brainer proposition, but Riskified even goes so far as to say that if they approve a transaction and it ends up getting charged back, then Riskified will cover the cost of that loss. That makes it a truly no-brainer proposition, and that's the big reason why I bought in. Now, powering all of this technology is the company's proprietary artificial intelligence, and based on those results, it seems like that artificial intelligence is working. When Brian and I first reviewed the company, it reminded me of another company that was making waves using artificial intelligence. That company's Upstart, a stock which I've wanted to own for a really long time, haven't been able to buy because of trading restrictions, but is clearly doing a good job at changing its niche using AI. So why am I selling my shares of Riskified? Well, it all comes back to this chargeback guarantee, which I thought makes it a win-win proposition, but also introduces a certain level of risk. As you can see here in this promotional material, Riskified says that it can offer this guarantee while still increasing your revenue. That's because it has designed technology specifically to approve high-risk transactions, and it's exceptionally accurate at detecting fraud, again, because of its artificial intelligence. Now, how can we know whether or not this is true? Well, if you dig through the notes, you see that it really comes down to gross margins, which has to do with the cost of revenue. Right here, Riskified states that cost of revenue primarily consists of chargeback guarantee expenses and other expenses directly related to this. In other words, if it's doing a good job at detecting whether or not someone is going to be fraudulent or not, then the cost of revenue should be lower. Nowhere will that be more apparent than in looking at the company's gross profit margin. Now we can see that gross profit margin was steadily improving from the third quarter of 2019 all the way through the middle of 2021, last year. The company went public right at this point, and it's about at that point that Brian and I reviewed this company, and I was so excited that I bought shares. Now, it's worth pointing out that because Riskified was such a small investment for me, it wasn't one that I was dedicated to keeping really close tabs on. So I took a while before going back to review my thesis. When I did, this is what I found. While the gross profit margins were going up right after the IPO, they fell precipitously thereafter. And while they've recovered somewhat, they're still far below where they were before. Now, there are reasonable explanations for why this happened. As the company highlighted in its own conference call, there is higher risk when they are in peak travel seasons because people can cancel their travel plans. Furthermore, they called out the fact that they've onboarded lots of new merchants. That's a good thing. And those new merchants might be in new industries like payments. What that means is the company's artificial intelligence hasn't gotten enough numbers to crunch to make it exceptionally accurate at detecting fraud. Now, is that a huge problem? Not necessarily, but if I'm going to be investing in a company that I think has a winning AI, I need to know that it is applicable, useful, and profitable starting today. I didn't get the feeling that that's what I was getting anymore with Riskified. And as you can see, this is such a small part of my portfolio, it's not a huge consideration. This doesn't mean that Riskified won't be a good stock to buy in the future. It just means that after reviewing the operations, I realized this was no longer a stock I wanted to hold. It's not going to make that big of a difference on my portfolio one way or the other. The real thing to point out here is that I didn't make this decision just because the stock went down. If the stock goes down, but my thesis is still very much intact, then it's worth holding on to shares, perhaps even buying more. And this isn't even necessarily to say that my thesis was proven wrong. Riskified has offered some pretty good reasons for why their gross profit margins have fallen. Rather, what this really shows is that I made a relatively risky bet on a company, and after going back and revisiting the thesis, what I really realized is that this is one of those that I'd rather put in my too hard pile and focus on other stocks that are down significantly from their all-time highs that I understand and have higher conviction in. What do you think of this decision? Let me know in the comments section below. Brian, out.